Welcome back to the podcast. Today is Monday, November 4th. We are recording this podcast before the U.S. elections. Hopefully the elections will be settled this week. We'll find out. Thank you for joining us. I hope you had a chance to check out our webinar. We're very excited, very proud of it. A replay version is on podcast as well as on our YouTube site, so check it out. We appreciate your feedback and every followers listening, and we'll go from there. So Ernest, how you doing today?
I'm recovering from a cold.
Great. Thank you for sitting so close to me. What's your take on the elections? We had an extra hour to worry about them thanks to daylights. I guess we're off daylight savings.
Yep.
Yeah.
We're off now.
So are you concerned? Are you thinking about them? I know we talked about them in the last podcast, but any changes since last week?
No.
Good. Me neither. We'll see what happens. In the meantime, today we want to talk about a number of technology companies that reported. We'll also touch on Warren Buffett and talk about a company in our portfolio that its stock went up over 20% after releasing its earnings, which was shocking. But first, we want to get to a Canadian company, Bell Canada, BCE, the ticker BCE on the Toronto Stock Exchange. I think, Ernest, we're pretty much zero-weight Canadian telcos in our portfolio. We have some fixed income and some preferred shares, but we don't own any of the equity.
No, I don't think so.
So BCE today announced that it was going to make an acquisition. Also, it's going to stop growing its dividend, and instead of paying down debt by selling its interest in the Maple Leaf Sports Entertainment, it is decided to try and get some growth. So we've talked about many times on our podcast why we think you should never buy a company for its dividend. No question, dividend is one source of capital allocation. If it makes sense and a company should grow its dividend, then that's great. But if you're attracted to a company that has a high dividend yield, please do your homework. Please research it. If a company eventually is paying out more than it's taking in, drastic actions have to be taken. And we thought one of the drastic actions that Bell Canada was going to take was to reduces debt by selling its stake in Maple Leaf Sports Entertainment, which turned out to be a pretty good investment for BCE. I think they paid about $1 billion and sold it for over $4 billion. So nice return. But it turns out they've decided that the capital is better spent on making an acquisition. So let's talk about the rationale. Hopefully that will work out for BCE. Its shares are under pressure today after announcing the acquisition. So really the ball is in the court of the management to prove that this was the right decision for its shareholders. Ernest, you have some more color on the acquisition?
So the company that BCE bought was called Ziply, which is basically it's an internet provider in the Pacific Northwest of the United States. So in places like Washington, in Oregon and Idaho, these kinds of states.
Does it compete with like AT&T or T-Mobile or Charter, some of those larger players? Okay.
So they're a fiber-based internet provider, and they compete against cable providers. Mm-hmm. And I think the market was quite surprised at this deal, as you can tell from the reaction to the stock price. Mm-hmm. And I think there's a few reasons for that. Number one, as you mentioned, is that the market was expecting that BCE would use the proceeds from the sale of MLSE to pay down debt.
MLSE, by the way, owns a stake in the Raptors, the Toronto Raptors, the Toronto Maple Leafs, the Toronto Argonauts, the CFL team, I think a soccer team, as well as a bunch of other sports-related assets. Anyways.
So that's the first part. Number two is that BCE doesn't have much of a track record of doing these kinds of things. They have no presence in the United States. And in the U.S., what we're seeing is, and the U.S. is generally a totally different market than Canada. In Canada, you have essentially the big three players that provide all sorts of telecom services. Like they provide cell phone wireless, they provide cable internet, they provide phone.
Even home alarm. I have my home alarm with Rogers.
And it's a very regulated business in Canada. Whereas in the United States, it's it's a very different market in the sense that it's generally unregulated, and there's a lot more competition among the various players.
Okay.
So the reason that BCE is doing this, according to their conference call, is that they think that this is an attractive growth market. It's something that they don't have a presence in, and that they think could be meaningful for shareholders down the road.
Did they mention any return metrics or
Yes.
why they're so excited about?
So I think where the skepticism is that they're paying about 14 times earnings before interest, depreciation, taxes, and amortization.
14 times EBITDA.
Yeah, EBITDA.
It sounds pricey.
Versus about, their own stock trades at about 7 times today. So they're paying a pretty high premium over their current stock price.
Yeah.
They're halting dividend increases going forward, and they're turning on a dividend reinvestment plan. So in essence, asking the people who are receiving dividends to put it back in through equity.
Yeah. And what when you turn on the DRIP program, that actually dilutes existing shareholders,
Yes.
right? Yeah.
And so, I don't really have an opinion as to whether this will work or not.
Mm-hmm.
But one thing I will say is that even though companies shouldn't be paying dividends, even though as investors we shouldn't invest in companies because of the dividend, companies have to understand what their shareholder base expects and wants from the business.
Mm-hmm.
And in the case of a company like BCE, it's very clear that the investors like predictable, stable dividends and a business investment profile that matches that. So a company that has reasonable leverage, a company that you can expect to just focus on its core business and grow that dividend over time. So for a company like BCE to go out and make an acquisition of something that is totally unrelated to their core business,
Yeah.
and pivot away from its core philosophy of raising dividends, it's a big surprise to everyone. And some analysts made the point on the call, investors in BCE aren't looking for growth.
Yeah.
Like what they want are dividends. And so if they want growth, there's a lot of companies they can invest in, like some of which we'll talk about later today.
Yeah.
But this is what the market gets confused by is BCE a growth company? Is it a dividend company? Is it a little bit of both? And so these are the kind of things that I think companies need to consider when doing these kind of moves.
Oh, we've seen a Quebec-based cable provider, Cogeco, make acquisitions in the U.S. Have those worked out?
I think the track record has been all right.
Okay.
But I think Cogeco is a very different situation in the sense that Cogeco has a large shareholder, that large controlling shareholder, and their capital allocation philosophies are a little different.
Their dividend isn't as high. Their leverage isn't as high as Bell Canada's, BCE's.
And the point about the investing in what your shareholders expect, I think this is especially important in today's market, where a large portion of the public stock of these companies is owned by strategies that are focused on things like dividends, let's say dividend ETFs, these kinds of things.
Well, it's not cutting its dividend. It's just saying for the next few years, whatever that is, we're not going to be raising the dividends because we're short-term pain, hopefully for long-term gain, right? Let's reinvest the cash flows, whatever they are, into trying to grow our footprint in the U.S. with this strategy that we're taking. I guess the point that we have concern with is I'm not so sure there's going to be any other cash flows to reinvest, right? Because even though it's not raising its dividend, it's still got a hefty amount of debt. It still has to cover the dividend, which is currently pretty high. I'm not so sure it's covering its dividend 100% if you adjust for a lot of different variables. So we'll see.
Yeah, we'll wish them the best.
We wish them the best. We will not be participating at the moment by buying shares of BC for our clients. And so let's move on and think about and focus on what we hope will be growth going forward from Apple. Apple right now is there's a lot of high expectations in the stock price. The company has announced a new phone, iPhone 16. It's selling quite well, but it's not the home run that people expected it would be to start a new super cycle to convince people who own iPhone 12 or 13 or 14 or 15 that you got to upgrade the phone. It's slowly rolling out its AI, or I guess they call it Apple Intelligence, whatever that means, adding new tricks and features that will try to get people to upgrade the phones. In the meantime, the results are quite decent for Apple. The year 2024, which Apple just finished, after adjusting for a large tax item and some currency, Apple had growth. And Apple returned at least to more flat sales in China, which was a huge concern. There are many people on Twitter and in the media saying that Apple was never going to recover again in China and sales were going to continue to plummet. Whatever Apple did, it was able to stabilize growth in China. So, Ernest, your take on Apple? Is the valuation worth it? Are we just being impatient? Should we expect more growth to come as more features and services are rolled out? No question, there'll be iPhone 17, iPhone 18, iPhone 19. So, your 2 cents.
This was a record iPhone quarter.
Yeah.
For the September quarter for Apple.
Volume of sales or revenue?
Revenues.
Okay.
Which was, no, to be fair, it doesn't really include any benefit from Apple Intelligence, which I think only came out last week.
Yeah. Is it available in Canada yet? I haven't seen any. You don't even have an iPhone, so I'm talking to a wall here. Okay.
Yeah. But what we're seeing is that Apple is slowly releasing out its AI features, and these are mostly incremental improvements to your phone, like small things such as message summaries or being able to generate emojis and these kinds of things.
And let's not discount those, how the young people, kids will really love those features.
Yes.
That will be a reason to upgrade. So as trivial as some of those things may sound to a guy who's 50 years old, someone who's 14, 15, 16, whose parents buy them a phone, they may really want to get the Apple iPhone that all their friends have.
And I think the initial response to Apple Intelligence so far has been, it's fairly mediocre.
Yeah.
Like the results are not very good. It's not as impressive as things like the ChatGPT or some of these other tools out there.
Yeah.
But I think the important thing to understand about Apple's approach to AI overall is that because Apple controls the device and they are able to give their AI permission to all of the apps in a way that it will never allow any other third party to do because of privacy reasons. And so that's why Apple, even if the rollout of Apple Intelligence is slower than expected, Apple will eventually be will be a big winner in AI because it's the only one that is able to allow you to use AI to control your phone.
Yeah, I see a lot of poo-pooing on FinTwit in the media about Apple, but it's the only one that's bringing 2 billion plus high-quality customers. These are high-quality customers that use Apple products and services, and everybody wants a piece of that. I'm not sure I can say the same for Android.
And I'm not sure about the exact pace of the upgrade cycle or whether people are going to switch because of Apple Intelligence.
Yeah.
But I am pretty sure that once you start getting used to these kinds of things, it's going to be harder to exit the ecosystem.
Yeah. Very exciting. So, go ahead. Yeah, please.
And one other thing I would want to say about Apple is that it's about their capital expenditures. So they're currently spending about $10 billion US, give or take, on property, plant, and equipment. Yeah. So this is in contrast to every other big tech company, which is spending like 40, 50, 60 billion dollars.
More, yeah, but we get the point, yes.
And the reason that Apple is able to be so capital efficient relative to the other big techs is because Apple's AI approach is that their AI models are all largely located on the iPhone. They don't require additional processing capability on a server somewhere
They're
else.
renting someone else's, right?
Yep.
So if someone's using ChatGPT on the iPhone, What does Apple care?
Yep.
It's ChatGPT's responsibility to have the server availability.
Yep.
Yeah.
And so Apple is providing the most valuable portion of Apple intelligence on device in a way that only Apple can provide, while outsourcing the most capital intensive and arguably commoditized aspect of AI, which is the large language models like ChatGPT and Perplexity and Claude and those ones, to third parties to spend the capex that it doesn't have to.
Yeah.
And so
Very interesting.
Apple has the most free cash flow generation out of all the big techs.
So here's how I think about Apple going forward. No question, the valuation at around 30 times earnings before cash looks pricey for a company whose growth admittedly doesn't meet our criteria today for an investment. But we think there are some reasons to believe that there's going to be a nice turnaround in earnings going forward. First of all, I think Apple has some pricing power that it hasn't tapped yet, right? Correct me if I'm wrong, but it's kept its iPhone prices pretty much stable over the last couple of years when it easily could have raised prices 5 or 10%.
Yep.
So that would have been a quite, one could argue maybe they wouldn't have been able to pass those through, but I'm not quite sure that would be true. Also, we'll probably see a refresh of wearables as well as iPhone and AirPods, as well as more products and services going forward. I think many people believe that the next iteration of the iPhone 17, will deliver even better features in terms of artificial intelligence or Apple Intelligence, however you want to call it. So I still think we're very early days. In the meantime, Apple was generating 100 billion plus of free cash flow, so able to buy back a lot of stock here. And I think that it's settled into its valuation, given that it's a consumer non-discretionary that you can't live without. And you can look at many examples of companies that don't have the growth or growth potential that Apple has that are even trading at higher valuations.
There was one line from the earnings call from Tim Cook, the CEO, that really stuck out to me.
Yeah.
Which is, I don't have the quote in front of me, but it's something like, we're always paying close attention to what's next and investing appropriately, or something like that. So
What does that mean to you?
So what that means to me is that what you see today from Apple is not all that there is to Apple. They're working on new things like, like the Vision Pro. We'll see what that turns into.
We forgot about that. Yeah.
But they are working on a lot of exciting things that we the public have no idea about and could be very material to the business going forward. And I think that they'll continue to do that.
Very good. So we'll be watching Apple quite closely going forward, as it is one of our largest positions in the portfolio, and it's been held for quite a long time. So speaking, I guess we'll stick with big tech. The AI 5, as they're known, Apple, Amazon, Meta, Google, NVIDIA. Is Apple an AI name? Anyways, it doesn't matter. But we had earnings from all the big tech names. NVIDIA will report, I guess, in a few weeks. Our clients don't own shares of NVIDIA. We really focus more on recurring revenue businesses. But the striking thing, I guess, we saw, and it wasn't like it was out of the blue or unexpected, was just the increase in Capex spending by Amazon, by Google, by Microsoft, by Meta on, going forward to facilitate what they think will be just an unbelievable demand for AI. So, Ernest, talk about the large Capex, and is it a concern, or is it something that the big techs are doing to, make their moat even bigger?
There was one sell-side analyst who said he expects the 5 companies, which would be the ones that you listed, plus Oracle, I think, to spend $288 billion on capital spending
in 2025.
Which is like that's a staggering amount of money that's being invested into.
What are they spending that $288 billion on?
Yeah, so a big theme over the last year or so has been what the return on Capex, like spending on chips and these kinds of things, going to end up what does it actually do in the end?
Yeah.
And I think the reassuring thing so far is that there is demand for AI services. So whether it be training new models, which is there's still a lot of that going on, or actually using the products on a daily basis. So like when you, for example, when you do a Google search and you see like the AI overview at the top, or when you use Microsoft Copilot or these kinds of things, like all of those require chips and AI services. And
it doesn't come from nowhere. So we use AI for our Zoom calls. It makes a transcript. Where do you think that comes from? You have to have the servers and the chips to generate and store that information.
And what we're seeing is a very clear acceleration of cloud growth related to these kind of AI services. So there is demand for it. And I think all of the big techs have been very careful to say that, like, you know, some of the portion of this Capex is going to very long-lived assets, you know, things like buildings and racks and those kinds of things that they can use in the future. And
let alone, like, even ignoring AI, many of these companies would say the demand for just cloud alone is just going to continue to skyrocket, right? So let's put AI aside. So whether it's AI spending or cloud spending, it's all going to eventually get used up.
And there's another portion of that Capex, which is going into the actual GPUs and the CPUs, which is more what they call based on demand signals.
And so that's the stuff from NVIDIA. Those are
And so they're very clear that this can be flexed up or down based on actual demand. And I think the one thing that is a little underappreciated about all this AI stuff is that all of these companies can internally roll out AI products to their customers. So if you think about Microsoft, they can roll out AI solutions and add it to Microsoft Office, which they're doing with Copilot. They can add it to PowerPoint. They can add it to Dynamics, which they're doing. And, essentially force its customers to adopt these AI solutions and drive demand that way. Same with Google and same with Facebook, right? They're able to drive adoption simply because of their large user bases today. And so I think they wouldn't be investing in it if they didn't see a return on it.
In the meantime, many of the CEOs have mentioned that the demand is there, that even if they could spend more money on these GPUs or CPUs or building more servers, they would, because they see the demand. And we have to imagine, like, we're not even in the first inning. We're not even, like, it's so early days for AI. We have these, these Firefly videos or text to video, but they can only make very short videos. And imagine if one could make a movie that way, God knows. But the need for data from the cloud, from these hyperscaling companies, is just going to be unbelievable. So I can see why they need to do it. In the meantime, they're the only ones that can spend the money on it.
And before that, I think people forget just how profitable these companies are. So like Microsoft and Google and Apple and Apple's not, but like Apple's not spending Capex, but companies like Facebook, these are just some of the most profitable companies in the history of humanity. And they're still buying back a ton of stock, even while they're investing this $288 billion.
Didn't Google and Meta just start its dividend? And many are calling for Amazon to start its dividend. And Amazon's like, we don't want to start a dividend yet when we got we got so much potential to put money on the AI stuff, and we've got so many other things we want to spend money on. Google wants to build out Waymo, which is its robo taxi. Meta is investing in so many different areas when it comes to AI. It hasn't even gotten started on trying to monetize WhatsApp, for example. So these guys have just, as you said earlier, I think you said it right. We have no idea what they're working on. We kind of know what they're working on, but there's so many other areas that they want to spend money on to capture growth. And so I think they're widening their moats. Yeah, I get the short-term pain. We all want that free cash flow now. We want that instant gratification. But I'd rather own these companies than a BCE that's looking at ways now, because it's screwed, because they can't get growth, and they're gonna, if they don't get growth, they're gonna have to cut the dividend. And so we'll take this 9 times out of 10. Yeah, I think, and that's just the way investing is, right, Ernest? It's there's never going to be a scenario where all that free cash flow is delivered to you and growing, and it's peak expenses, and all the money gets back to the shareholders, and everybody's lovey-dovey in utopia. Never happens. No. You want these companies to reinvest and grow for the future. So speaking of a large Apple shareholder, well, not as large as it used to be, is Berkshire Hathaway. The earnings came out on the weekend. Really weird that it reports earnings on Saturday.
I actually think more companies should do this.
Yeah, but he doesn't even have a conference call. Like, what does it matter when he reports earnings? Because he never tells you about them anyways. And so report them during market hours. But yeah.
The funny thing about Berkshire's earnings is that they're actually really detailed.
Yes.
For a company that doesn't do conference calls. There's a lot of quarterly reports that from a lot of companies where they're just like, well, why were revenues up? They were up because they were up, right? And they don't really give you any details.
We have a few companies in our portfolio that they don't give you any details at all whatsoever, right?
But Berkshire is very detailed. They'll tell you, okay, this is what exactly happened to our insurance business. This is what happened to Lubrizol inside our business. This is what happened to Precision Cast Parts.
Interesting.
Quarter by quarter. So it's actually a very detailed report.
So I see the market reaction today to Berkshire's earnings is negative. I think there's a lot of confusing headline numbers in the report, and people wondering, what the heck is Buffett doing? There's sold more Apple, selling more Bank of America, didn't buy back his stock, didn't buy any really stocks. I think a little bit of Occidental, maybe, but I don't think they bought in the third quarter. So like, what the heck is Buffett doing? $300+ billion in cash, Ernest. But I think we need to break it down a little more. We don't want to do a full podcast on Berkshire, but what is your take from what do you think Buffett is doing, and is it more? I guess what I'm trying to say is that it's not as bad as what people are making out to be.
Well, I don't think anyone's saying it's bad.
No, I just think it's reckless or there's no thought process. But I think we think there's maybe a really good thought process here.
Yeah. So as a whole, the results were actually pretty good.
Yeah.
A lot of the problem areas from last year are improving. So,
yeah, we did a podcast on that, by the way, right? Yeah.
Geico's getting better. The railroad BNSF, that's getting better. The utilities are getting better.
Nice.
I think the other stuff that they have, which is called manufacturing, service, and retail as a group.
Yeah.
I think that was down, but those are fairly mature businesses. So doesn't really matter individual. None of those companies matter individually to Berkshire.
Got it.
And I think that's the reason why people generally focus on what he's buying and selling.
Wasn't the company's results also affected by the recent hurricanes in the United States?
Yep. Yeah. I think that he quantified the expected loss from the hurricanes.
Okay.
I think the big debate is around what exactly is Buffett doing? Why does he keep selling stocks?
Yeah.
And why does he hold so much cash?
Yeah.
And basically you have to ask Buffett.
Yeah.
I think Buffett has said it many times, like, if you like the way I invest, then you own Berkshire stock.
Yeah.
If you don't like the way I invest, don't own the stock. But then don't try and like copy my trades, and copy the trades that you like, and don't copy the trades that you don't like.
And right? Don't speculate as to what I'm doing, because I can change my mind in a heartbeat, right? There's a lot of cash on the balance sheet. Well, I think he said it a number of times. He is worried about rising taxes.
Yes.
So take some capital gains now. And a bird in the hand. He is seeing that he can get 5% on U.S. Treasuries, although that may not last for very long. But he's taking a very safe approach, right? This is the first time in 20 plus years that Berkshire can get 5% on Treasuries. And so that changes the calculus for so like Buffett's, and we've said it a number of times, Buffett's goal is to protect your money. That's it. He doesn't want a blow up. He doesn't want huge mistakes. He treats, whether you have one share of Berkshire or a billion, that he's managing all your money just like a portfolio manager, and he doesn't want to take the risks. And whether or not he thinks Apple is overvalued, undervalued, whether or not he's building cash because maybe one day he's eventually going to pass the torch to Greg Abel, who will be maybe it's better for him to start with a cleaner slate. I don't know. You don't know.
Yeah, I think we were talking on the weekend, and you had an interesting theory about that, about how he was possibly cleaning the balance sheet a little bit just in preparation of Greg Abel taking over.
Well, there's already signs of Greg Abel making changes at the railroad it's early, but a decent result for the first quarter that we've seen in a while, where it's positive year-over-year growth. So hopefully that's Greg Abel really making inroads into the company. You have to be insane to have that much of your portfolio one stock. And had Buffett left Apple alone, I think it would have been like $226 billion out of a $370 billion portfolio. It's kind of too much. Even if you love Apple, it's 50% plus.
And I think, like Buffett is Buffett.
Yeah.
And, but he has his own opinions on what he wants to do with Apple. And, we have our own opinions on what we want to do with the stock.
And it's a lot of dumb headlines or people tweeting, oh my God, he's dumping Apple. He's dumping Apple, and it's still his biggest position by far. So yeah, I don't think he's necessarily dumping Apple. He's just rationalizing the position, which he bought at a very great multiple, and trimming probably makes sense here, given how big it's gotten in the portfolio, and for the reasons we mentioned, capital gains, what have you. So we're watching closely that there will be a turnaround in Berkshire's results, because I've seen some people posting that that should be the biggest concern is, can the company continue to be a compounding cash machine?
Yep.
So any other points on Berkshire?
No, I wouldn't say so. I think there has been some negative buzz about like the performance of some of his investment deputies at Berkshire recently. And again, I think my take on this is that it comes down to your judgment of Buffett's judgment, right? Like, do you trust him to pick the people to run the company? And if you do, then you should own Berkshire. And if you don't, then you shouldn't own the stock, right?
I think a lot of their responsibilities have changed though over the years, right? So one of his deputies, Todd Combs, is now very involved in Geico.
Yes.
Very involved in other parts of the business. So maybe the stock picking has taken a step back for them. I'm not sure.
Yeah.
I can't comment. I don't work there. Buffett didn't hire me or Ernest, so you'll have to settle for us managing your money. So our final conversation will be on Garmin, which reported. So big picture or little picture on Garmin. Prior to reporting its earnings, two major analyst companies downgraded Garmin, saying that they're worried concerns about consumer growth, that Garmin was trading at too high a multiple, is trading above its historical range, blah, 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 yada, yada, yada. And that was a reason for downgrade. And then lo and behold, Garmin reported a stunner of an earnings release that anybody who was short the stock obviously got caught offside. And talk about, Ernest, a little update on Garmin, and do you think things are going to continue to improve from here?
Garmin had an unbelievable quarter, and this is especially true if you compare them to Apple's results. So their watch sales, so they have two segments for watches, which is outdoor and fitness. Outdoor was up 21%, and fitness was up 31%.
Year over year.
Extremely strong growth rates.
Yeah.
And if you compare that to Apple, their wearable segment.
Down.
So Apple is the leader in the watch industry, like the smartwatch industry. I think they're by far the leader. They were down, that segment was down 2%. So that wasn't all watches, but enough of a picture to show how much Garmin is crushing it. And I'm going to read out what the CEO of Garmin said about why the results were so good.
Go ahead.
So he said this: "Some are wondering how we have consistently delivered strong results when the financial health of the consumer is the subject of intense debate. The straightforward answer is that there is no single profile of the Garmin customer, and therefore our results are not strictly correlated to broad generalizations of consumer behavior. Our business is highly diversified in many dimensions, from market segments to product categories within segments, each targeting different consumers. Additionally, our business is global in nature, allowing us to leverage growth opportunities wherever they exist. And finally, our products offer essential utility and unique differentiators that separate them from ordinary discretionary items.
Very interesting.
So what he's saying is basically, well, like people like our watches and they want to buy them. And that's why our results are so good. And I think the question naturally becomes, well, is this as good as it's going to get?
Yeah, because that was the worry, of course, a month ago when two analysts downgraded as it's already as good as it gets. And then they reported a quarter that's way better than as good as it gets. And so now, of course, I would assume they would be coming back and pounding the table and saying, yeah, now it's the peak, right?
Well, I think the important thing to think about Garmin is that obviously they're not going to grow like 20, 30% watch sales every year.
Well, you can wear two watches on your hands or three. Yeah.
But
yes, yeah.
If you look at like the track record of these segments is that they have been fairly consistent double-digit growth businesses prior to 2021. So like from most of its history when Garmin started selling these watches, this was a growth business.
Yeah.
It really took a peak in 2021 and then fell down because everyone already bought one.
Yeah.
And so some of the strong result is just them making up what they, just getting back to where they were in 2021.
Sure.
But then if you put in perspective Garmin's watch sales relative to the industry, they're still very small overall. I think together they sell about $3 billion in these two, the outdoor and fitness segments put together, versus, I don't know, $40, $50 billion of Apple wearable segment sales. And so there's a lot of market share for Garmin to gain here. Not to say that I think they're going to overtake Apple or anything like that, but they have a lot of these are well-engineered products. I think the brand name is getting stronger as people start to see people wear them and recognize them for what they are. And I think that they're going to continue to do what they do.
Excellent overview of Garmin. Anything else to add?
They also did an acquisition of a company called Lumishore, which is the leader in LED lights for boats.
All right. So like to get you to shore when it's dark, or to pimp out your boat?
More of that.
Yeah.
The latter. But so our president, David Baskin, as those of you who know him know, he's a huge boating and sailing enthusiast. And the reason why you want LED lights on boats is because, he told me this, is because it's very hard to change the light on a boat. And so you want it to be LED.
Yeah, lasts forever.
So it lasts forever.
Yeah.
Right? And so the interesting thing about Lumishore is that it already connects into the boat control panel, right? So
run by Garmin.
Yeah, of which Garmin is the leader in that segment. So this is just another way for them to really add a product that people might want to add on their boat and provide a system that connects into it.
So already taking advantage of a relationship that it has with a supplier, bringing that supplier in-house and looking to sell ancillary products. That's what Garmin's been doing for a very long time in its boating and its aviation business, correct? Yeah, so wonderful business, great results on Garmin. Hopefully that will continue going forward. Thank you so much for joining us, and we'll see you back here real soon.